Welcome to our channel, Navesta Videos. Today we will be discussing common shares purchase and buying options contracts. When it comes to investing in the stock market, two of the most common methods are purchasing shares and trading options. While both can be effective strategies for building wealth, they operate on fundamentally different principles and come with their own sets of risks and rewards. Understanding these differences is crucial for anyone looking to navigate the complexities of the financial world. Let's start with purchasing shares. When you buy shares of a company, you are essentially buying a piece of that company. Each share represents a fractional ownership stake, and as a shareholder, you have a claim on a portion of the company's assets and earnings. This means that if the company does well, your shares can increase in value, and you may also receive dividends, which are payments made to shareholders out of the company's profits. The more shares you own, the larger your stake in the company, and the more you stand to gain if the company performs well. The process of purchasing shares is relatively straightforward. You open a brokerage account, deposit funds, and then place an order to buy shares of a specific stock. Once your order is executed, you own those shares outright. This ownership is not just a theoretical concept. It comes with rights, such as voting on important company matters during shareholder meetings. However, it also comes with risks. If the company performs poorly, the value of your shares can decline, and you could lose money. The stock market can be volatile, and prices can fluctuate based on a myriad of factors, including market sentiment, economic conditions, and company performance. Now let's shift our focus to options trading. Options are financial derivatives that give you the right but not the obligation to buy or sell a stock at a predetermined price within a specific time frame. There are two main types of options: call options and put options. A call option gives you the right to buy a stock at a certain price, known as the strike price, before the option expires. Conversely, a put option gives you the right to sell a stock at the strike price before expiration. One of the key differences between options and shares is the leverage that options provide. When you buy an option, you typically pay a fraction of the price of the underlying stock. This means you can control a larger amount of stock with a smaller investment. For example, if a stock is trading at $100, purchasing one share would cost you $100. However, you might be able to buy an option that gives you the right to purchase that same share for, say, $5. If the stock price rises to $120, you can exercise your option, buy the stock at $100, and immediately sell it for $120, netting a profit. This leverage can lead to significant gains, but it also comes with heightened risk. If the stock doesn't move in the direction you anticipated, the option can expire worthless, and you lose the entire premium you paid for it. Another important aspect of options trading is the concept of time decay. Options have expiration dates, which means they lose value as they approach that date. This is different from shares, which you can hold indefinitely as long as the company remains in business. With options, if you don't act before the expiration date, your right to buy or sell the stock vanishes. This time sensitivity adds an additional layer of complexity to options trading, as you not only have to predict the direction of the stock price, but also the timing of that movement. Moreover, options trading can be used for various strategies beyond just speculation. Investors often use options to hedge their positions, protecting themselves against potential losses in their stock holdings. For instance, if you own shares of a stock and are concerned about a short-term decline, you might buy a put option. This gives you the right to sell your shares at a predetermined price, effectively setting a floor on your potential losses. This strategy can provide peace of mind, but it also comes at a cost, as you will need to pay a premium for the put option. In contrast, purchasing shares is a more straightforward investment strategy. You buy and hold, hoping that the company's value will increase over time. This long-term approach can be less stressful than options trading, which requires constant monitoring of stock prices and expiration dates. For many investors, the simplicity of buying shares aligns with their risk tolerance and investment goals. They prefer the idea of owning a piece of a company and benefiting from its growth rather than engaging in the complexities of options trading. However, the potential for higher returns with options can be enticing. For those who are willing to take on more risk and have a solid understanding of the market, options trading can be a lucrative endeavor. It allows for a variety of strategies, from simple calls and puts to more complex spreads and straddles. Each strategy has its own risk-reward profile, and savvy traders can tailor their approach based on their market outlook and risk tolerance. In summary, both purchasing shares and trading options have their merits and drawbacks. Shares represent direct ownership in a company, with the potential for long-term growth and dividends, but they come with the risk of price volatility. Options, on the other hand, offer leverage and flexibility, allowing for various strategies, but they also introduce complexities such as time decay and the risk of total loss. Ultimately, the choice between shares and options depends on an individual's investment goals, risk tolerance, and understanding of the market. Each path offers unique opportunities and challenges, and the key is to find the approach that aligns with your financial objectives and comfort level.